The Indian economy continued to slow for the 6th consecutive quarter. The number came in as expected, but that's not much to write home about because at 4.5% GDP growth, we're at the lowest levels since 2013. GVA growth fell to 4.3%. Perhaps the only thing you can take heart from is that 4.5% was in line with the high-frequency indicators and was close to the consensus estimate put out by economists polled by Bloomberg as well. Apart from the real GDP growth, which tends to grab the basic headline, focus a little bit on the nominal growth number. Nominal growth accounts for price changes and inflation, and nominal GDP growth came in at 6.1%. It was already very low at 8% last quarter. It fell further to 6.1%. This appears to be the lowest in about a decade. GVA growth at 6.3% based on Bloomberg data suggests that this is the lowest since 2002. Nominal GDP growth matters for companies whose earnings closely linked to nominal GDP growth, and that's why we are worried about the nominal GDP growth number. It also has a bearing on government finances because it means that the deficit number will look higher if your nominal GDP is lower than the 11 to 12% budgeted by the government. There is one aspect, a slightly technical aspect, which worth keeping in mind, and that's the deflators. The deflators are used to derive real GDP from nominal GDP, and the deflators are actually lower this time around because they link up to wholesale price inflation, which has been low in this quarter. So that would mean that your real number would perhaps look a little bit better because of that lower wholesale price inflation. Let's go back to the sectoral trends within the GDP number, and you'll see that you've got a weak number in industry as expected at a negative 0.5%, but again not as bad as some had feared. Some economists were suggesting it could be as low as 2% contraction. Not that bad, but still worrying given the slide that you've seen in growth in the industry. Agriculture was flat, as was services. So the industry component with sectors like construction, manufacturing, etc., continues to be a point of worry. If you look at some of the other aspects of the GDP number, it's always the expenditure side data which gets a lot of attention. Last quarter, we had seen a fall in personal consumption growth to 3.13%, and that had raised alarm bells about the consumption story in India. Well, you got a bit of a pickup this time around to 5%, but again, that's nothing to write home about because if you look back a few quarters, you've been ranging at about 7 to 8% growth in personal consumption. So at 5%, it's still a little bit weak, but perhaps better than the first quarter of the year. The other notable point is the 15% increase in government consumption shows that government spending picked up in a big way in the second quarter after the elections were done, and that supported the economy. Gross fixed capital formation after a period where you were seeing some pickup has been sliding and came off to 1% this time around as well. The question that you're now left with is what is the policy mix to correct this 4.5% GDP growth and the 6-quarter decline? Well, it does look like the heavy lifting will continue to be done by monetary policy. This is despite the fact that inflation has actually picked up to above the midpoint of the Monetary Policy Committee's 4 plus minus 2% range, but they will probably look through that because that's largely coming in from a handful of vegetable prices and focus on core inflation, which has been very weak, along with focusing on GDP growth, which, like we said, at 4.5% is the lowest since 2013.